Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 222. Today is 5th of May and we had a huge gap up in the markets this morning after the Fed hiked interest rates by 0.5%. The market was expecting 0.5%, but there was also nervousness that there may be a 0.75% hike. So with that not coming in, the market did a sigh of relief, and a relief rally started from the US markets, then to the Asian markets in the morning. And our markets also opened dramatically up after a big beating yesterday, post the sudden RBI 0.4% hike in the repo. In terms of the overall market today, as I said, most sectors got beaten back down. Real estate took a specific hit more than others, as it is deemed that with the hike of interest rates, the low interest rates that were available in the country for almost past 2 years, that low is now gone, and incrementally if the rate cycle goes up, demand for housing loans etc. Will soften. IT stocks, on the other hand, did quite well, maybe on the back of Nasdaq stocks doing well. And also IT has been beaten down, blue and black, quite a bit in the last month, almost 14% down this sector. So there will be some relief rallies at some point. But other than that, most sectors were either flat or down. And for the past 1 week or past 1 month, most sectors are now pretty much in the red. On the broader indices, we can see that most indices were flat, absolutely, but small caps and mid caps lost more ground, so they were lower than even yesterday. In terms of weekend investing strategies, a few strategies were in the green. EverGreen was up 0.84% with the gold component in it also. NG 50/50 also 0.6%, but some strategies were down between 0.5% and 0%. So not a very exceptional day either way, but pretty much on par for the day in terms of the indices. ABB, Future Consumer were large gainers today in the CNX 500 universe. Ujjivan, Adani Green and Varroc Engineering up almost 6% each. So there were pockets of good strength in the market. In terms of downsides, Intellect Design, Angel One, East India Hotel, Godrej Property, Deepak Nitrite, after supposedly good results, also fell between 6 and 7%. So there were pockets of weakness alongside the flat market as well. There was an insight regarding this monetary cycle that we seem to be going around in circles. So the Fed prints more dollars out of thin air. These extra dollars find their way into the system either by cheap loans or by way of stimulus given by the Fed to consumers or businesses. That leads to a huge demand surge, or that extra money, extra dollars seek refuge in some asset investments, causing huge inflations in various pockets. Once the inflation crosses the affordable level for the Fed, they start the interest rate hike cycle. Interest rate hike cycle eventually results in recessions, as corporates can't bear the additional new cost of funds and new investments dry up, and eventually the interest rate cycle is brought down by printing more and more dollars by the Fed and pushing more and more stimulus into the economy, and we keep repeating this cycle. So what this is doing is it is causing higher and higher debts in the system. Debt to GDP is increasing dramatically for most countries, and this is not really going towards any solution but just kicking the can down the road, as with each cycle, the toolbox for the central bankers becomes more and more limited. Like in the current cycle, we have seen the Fed rates or the yield, 10-year yield, for instance, on the US go from 0 to about 3% now, and already the market is very jittery. At another percent or percent and a half, I think it may become very difficult for a lot of businesses or consumers who are sitting on huge debts to even service their loans. So with each cycle, that absorption power keeps going down in every economy, and eventually this has to morph into some sort of a new monetary system where some debts will have to be written off and the plate and the slate struck clean. When and how that will happen is anybody's guess, but we are currently stuck in this cycle of a monetary system. Another insight was that crude, which is still nearly 105 to 110 levels on Brent crude, is now being accepted as a reasonable normal level. A year back, when it was 40 to 60 range, maybe 100 at that point would have seemed dramatically high. But now, because of recency bias issues, our mind tends to think that $100, $110 is fine because we are able to sustain it right now. And the same happens in stocks. When a stock remains at an elevated level or at a very low level for a long period of time, we tend to believe that that is the correct valuation or the right price, and that may not be so. I mean, that's just the recency bias mind in our minds playing that trick. Car trade is one stock which was humongously volatile today, and after in the first hour, despite morning gap of the market, this stock opened almost 10% down, went to near 570, and then it later on went to about 680, 660 something. A huge volatility in some stocks. Maybe it was driven by some news, I have no idea, but post this news that came out in the morning, it seems that the shorts were trapped and they were made to cover in the latter part of the day. The big topic of the day is that themes don't last forever. So I've been in the market for more than 2.5 decades, and I've seen hundreds of themes play out, whether it was .com in late 90s, whether it was infrastructure in 2003 to 2007, commodity-led themes, ESG, wind and solar power themes. Currently, we are also having EV or Atmanirbhar company themes. So most of these themes have a very limited shelf life. Some are micro themes, some are macro themes, some may last for some longer time, most will last for a few years. So one should be very wary about getting into a very long term commitment based on a theme. The themes usually are popularized once that sector has run up quite a bit, and the stock price movement post that point may or may not be conducive for your growth of your portfolio, and a lot of people I've seen get stuck in themes without having any exit plan. So if you are going for a thematic sort of an approach, you must have some framework around your investing, because themes can really take you to ruin. There can be, I remember, stocks whose name you may not have heard, but who are, sort of the thematic kings in their own times, whether it was software stocks, whether it was infrastructure stocks. Currently, power stocks are ruling the current theme. Paper stocks sometimes do that. Sugar stocks are doing that. So it's very, very thematic in that in those terms, but themes very quickly switch as soon as they mature and they become overvalued from the perspective of over ownership also. So be very careful with thematic investing. Have a bouquet of themes if you have to, and always have a exit plan in your hand. So this is all I have for today's daily bite. Do keep telling me whether you're liking it or not, what kind of content you would like to see. Please do keep sharing it with people who you think can make use of it. Most of the folks who have absolutely no exposure towards the market have always been afraid of the market. You should introduce the markets to them. I think as a market participant, this is your sort of karma that you can do to bring your friends, family, and others who have been losing purchasing power, sitting on other asset classes, to bring them into equity and giving them the right sort of lead into it. So I think as a good investor, you must do this activity as well. So thank you so much for watching. I'll see you in another video. Bye.